Well, so the traditional playbook, where you buy a property, and even if it's a single family or a larger multi, you buy something under market, getting a good deal on it. Maybe it has outdated interiors, needs some renovations. Maybe it hasn't been managed right. And then you improve it over time, raise the rents, raise the valuation, cash flow. And that was typically the approach for most of us syndicators over the last couple decades, actually. And so what's interesting right now, though, is the dynamics have shifted dramatically, and infusing capital to improve properties isn't necessarily increasing rents anymore to the valuations that we need. In fact, interest rates rising are decreasing valuations, and inflationary costs have driven the cost for construction or renovations.
Welcome to the Cash Flow Fight Club podcast. I'm Mike Deaton.
And I'm Lygia Deaton. Together as co-hosts in life, business, and this podcast, we're matching up the heavyweights of cash flow creation to see who reigns supreme.
We do this so you can discover the best way for you to generate transformational cash flow and pursue the life of your dreams. So whether you're a side hustle seeker, full-time entrepreneur, or just looking to create job-quitting cash flow like we did, hit subscribe and grab your ringside seat for the most entertaining and informative investing show on the airwaves. Let's get in the arena.
Let's do it.
Stepping into the Cash Flow Fight Club arena today and facing off are two alternative investments that are each making the most of the current market conditions. Solid cash flow, great overall returns, and tax advantages. You can't get much better than that.
This is a really fun matchup with two gentlemen that know their investments and are good friends of each other. So let's get to it.
All right. Coming to us from the island state of Hawaii, our first guest cut his teeth in engineering and corporate America to create one-of-a-kind automation and robotics for manufacturing companies. He's been active in the real estate investing sector for over 15 years. After experiencing and barely surviving the market crash of 2008 and 9, he refined his investing approach. Focusing on essential goods and services like energy and housing, he's now running an investment fund that capitalizes on these tough market conditions and targeting distressed multifamily properties that can be purchased under market value and deliver immediate returns with minimal additional capital. He's raised investments totaling over $50 million and acquired a $600 million portfolio, including 5,000 units of multifamily. Please welcome author and founder of Invest on Main Street, Patrick, the engineer of great returns, Grimes.
Yes.
And fighting out of LA, California, our next guest started out in the medical sales field and shifted into real estate as a way to help those high earners develop passive income so they can stop trading their time for money. He's a partner in over 2,000 units of multifamily, totaling over $200 million in value, and has raised and invested over $35 million in capital. Today, he's representing the power of investing in automated teller machines. He's an author, public speaker, mastermind, and investing club host of his own podcast, The Mailbox Money Show. Please welcome Bronson, the Spartan Warrior Hill.
Woo-hoo!
As immortalized by the legendary Michael Buffer, let's get ready to rumble! All right, so welcome Patrick and Bronson to the Cash Flow Fight Club podcast. We're looking forward to a great matchup today. Appreciate you both for joining the show today.
Yeah, I'm glad to be here. I was a little worried until I found out it was Bronson, and now I'm ready to go.
Yeah, it's a pushover. It'll be a first round TKO. You're going to have it.
Well, I got my gloves out here, man. I'm literally ready. Listen, I got my boxing gloves on. I'm ready to take that guy down and punch through the screen. And you're going to feel this, Patrick. So get ready.
He's got a very light touch. That's why he punches with pillows.
That's right. The gloves come off then. It might be, might come off.
So a little backstory. You guys know each other very well, it sounds like. Have a few years of history and cross paths quite often. I think Bronson was telling us, Patrick, that you were speaking as recent as yesterday. So we're looking forward to a spirited matchup here.
Absolutely. I mean, we're actually really good friends, but when we're not in the arena, when we're actually fighting each other, we just leave all that.
That's what you got to do. That's how you have to do it.
Today we're battling it out. I'm ready for it.
Awesome. Welcome, both of you. And let's kick off round one with Bronson. Bronson, tell us a little bit about your background and what were you doing before what you do now? And what led you to this type of alternative investments?
Before I was a professional boxer or after?
Yeah.
Okay. Well, I was in medical device sales for about 10 years. I was making really good money. I basically went into surgery and helped heart surgeons with some of their equipment. And so it was very interesting. I learned a lot. I was making over $200K a year. It was great. But I really wanted financial freedom, which to me, and I think for most people, involves time freedom. And so a lot of the medical profession, people just don't take much time off. And if you don't go to work, you don't get paid. Even physicians that I worked with, some of them were making over $2 million a year, and they just couldn't take time off. They're working 60, 80 hours a week, some of them. And so I really wanted to try to learn about passive income. And so long story short, started doing single family, realized that was not going to get me where I wanted to go, which most people have. I think Patrick's story as well, a little bit of that's there as well. But I learned about syndication and multifamily, and started to meet up in Los Angeles area. It's actually where I met Patrick, and then just started scaling up. And now we've raised almost $40 million for about $200 million in multifamily apartments. We also have ATM machines and car washes and oil and gas. And I love what I do. I'm getting ready to go on international trip number 6 of the year. I'm going to Fiji and New Zealand in about 2 weeks for 2.5 weeks. So I'm just love being able to help people to replace income or generate passive cash flow.
That's awesome. Yeah, what a great path. That's a familiar refrain, I would say, for a lot of professionals that trade time for money, like doctors, dentists. We know a few surgeons, and they are all looking to innovate some type of medical device so that they don't have to practice. They can ride on the royalties of some kind of knee replacement or something there. That's the holy grail for a lot of them. But passive income and investing is a really great way, especially for a lot of those high income earners, right? They have the money. They just need to get some cash flow coming in. So yeah, it's great. How about you, Patrick?
Well, yeah, so I started somewhat similar parallels to Bronson. I was a high-paid professional, and I wasn't in medical device sales, but I was doing high-tech machine design, automation, and robotics. So I was a mechanical engineer and started out my first automation house that I got a job with. The owner said to me that I should invest in real estate. And I was shocked to hear that because he was he had just knocked it out of the park in this high-tech space. But he made it very clear that the sooner I invest, the more I invest as early as possible is what his only regret was not doing that. And so I immediately got way over my skis, invested in some risky development projects, lost it all in 2008, 9 and 10, and drug me over the coals pretty bad. Got a master's in engineering and business, got way up in the corporate ladder, trading time for money. Started pulling bonus, needed a place to put my investments again, followed the breadcrumbs of the wealthy right back to real estate. But this time, how to do it safer, be the tortoise, not the hare, buy for cash flow, and got into single family, and then traded up to larger apartment buildings. And so I partnered in about 4,000, little over 4,000 units in multifamily, about $500 million in assets. And I also we've diversified into energy portfolios as well. And because I'm really an alt asset guy, and I'm looking for those tax advantaged cash flow that's recession resilient, that provides long-term appreciation. And I left the engineering stuff behind. In fact, I remember when I first started attending Bronson's meetup, and I was like, hey, I'm a single family guy. I want to start buying apartment buildings. And he was pretty sure I think I was another one of those tire kickers that came by. And so, but then all of a sudden I started buying apartment buildings. And he was like, what the heck?
So Patrick, it says about Patrick. So yeah, I met him, and he showed up with his wife 2019, and just I've never seen somebody take more action in a short amount of time. And just, I just have so much respect for what he's developed, and he's just doing way bigger things than I'm doing. And I'm like, Patrick, teach me how to do this, whatever. So he's up the game. And I was saying too, I think your automation background, where you were working with like machinery automations, it's helped you a lot in your business to really scale and to grow. And I really admire that part of how you're doing it. So we're getting the pleasantries out of the way, because when we get
the
gloves are
I
coming
basically
off.
rode the jet stream behind Bronson, right? He took all the blows, and I just followed along with when
and then he just passed me. Then he just like, I think I see him off on the horizon there. But yeah.
He drafted.
I did right at the end of the Tour de France.
That's awesome. Yeah. Again, a familiar refrain we hear from so many people. I wish I'd have started earlier. That's definitely the mantra of the real estate investors, unless you know people like the Donis brothers who start when they're 20 or whatever, right?
They wish they'd started earlier too. They're like, oh, I was a teenager, right?
Those kids blow me away. Good for them.
Yeah. All right. Shout out then to the Donis boys. But good stuff. So today, you guys both have really diverse backgrounds. You're well diversified across asset classes and things, as you mentioned. So today, Bronson, you'll be giving us the ins and outs of ATM and cash machine type investments, and then Patrick, for you, it'll be multifamily acquisitions and really how you take advantage of the moment of the day, I guess, in terms of where assets are sitting. But yeah, we can roll into round two here, and maybe Patrick, let's stay with you and just give us an overview and some of the ins and outs on multifamily acquisitions and what you're doing there, and some of the basics from an investment standpoint, like as an investor coming in, what they can expect in terms of time and ROI and a few elements like that.
Well, so the traditional playbook, where you buy a property, and even if it's a single family or a larger multi, you buy something under market, getting a good deal on it. Maybe it has outdated interiors, needs some renovations. Maybe it hasn't been managed right. And then you improve it over time, raise the rents, raise the valuation, cash flow. And that was typically the approach for most of us syndicators over the last couple decades, actually. And so what's interesting right now, though, is the dynamics have shifted dramatically. And infusing capital to improve properties isn't necessarily increasing rents anymore to the valuations that we need. In fact, interest rates rising are decreasing valuations, and inflationary costs have driven the cost for construction or renovations. So what we really definitely need to share the difference between the yesteryear, like literally a year ago, and past, and even through the 2008 downturn. The economics were not like this all at once for multifamily, and where we're at now today. And the reason why I want to make that differentiator is because we can't do deals like that anymore. You can't buy and hope. You can't buy and renovate and then calculate. In fact, I'm an analyst, and that's what I loved about it before. Is I could be very much, here's the projections, here's the comparables, there's their rents. I could infuse capital and renovate, raise the rents. Here's the valuation. Here's the exit. My crystal ball is broken now on the typical multifamily play. And so the reason why that's really exciting is because when markets are troubled, there's opportunity, right? Mm-hmm. And in this particular opportunity, as I mentioned before, I lost everything in 2009 and 10. I had way over leveraged in one asset. I had gone all in. I wasn't cash flowing. It was a pre-development. I was hoping to be able to get to develop, and I was hoping to be able to build something. I was hoping to be able to sell it or cash flow. Market fell apart, right? Since then, we built a portfolio that can ride out a recession, but doing a deal today is very different. Why? Because when we go to look at opportunities, there's a ton of investors that didn't build their hadn't been through a downturn. They didn't build their portfolio to ride out a downturn. They didn't buy rate caps. The interest rates of consuming all their income, and now they're paying out of pocket. They didn't raise enough reserves. The evictions after COVID, when people stopped paying rents, those skyrocketed, but there was an eviction ban. And when that lifted, the courts are backed up, right? So there's all these things with taxes and insurance going up, hitting the market right now. And if you weren't built with a strong financial foundation, you're in a tough point. And the reason why I'm pivoting away from your question, because I'm saying, well, in this recessionary time, how do you do deals? And that's why we have the Recessionary Income Fund. You're really going to take your thinking cap off, because right now we're not buying and holding and renovating and hoping. Right now we're buying properties all in cash that are from operators that are troubled. They need or want out right away. We closed within 14 days after we were done with our due diligence on last asset. There were multiple higher offers, but we moved faster. And as soon as we bought it, we bought it a first asset for $4 million. It appraised for $5 million shortly after that. It's cash flowing in a 10 cap, all in cash at 10%. And it's 60% occupied. And we're already putting them, it's a strip center. It's a retail center. It's not just multifamily. Multifamily, strip centers, industrial. But after lease up, it's worth $8 million. What's the CapEx infusion? Almost nothing. It's almost negligible. So the strategy behind recessionary acquisitions, and I just published an article last week on Forbes, the upside of downturns, recessionary acquisitions. Patrick Grimes Forbes. Check it out because I go step by step. It's the velocity of capital. It's making a return on the buy, moving quickly, going direct to owners, finding ones that are troubled, being the source of that relief financially, acquiring it so that you make that stair step in your equity on the acquisition. Immediately verifying out part of it, buying another asset where you make a stair step, and doing a tax advantage exchange, immediately selling the first asset to a third asset. And by that, you turn one asset into two and two into four. And now as we approach 2025, when the distressed operators are only going to grow, as the interest rates are finally hitting the bottom lines, reserves are running out, we want to buy as many times as we can. Because it's the people in 2009 and 10 that took action and purchased as much as they could, as quickly as they could, that are the billionaires today. Mm-hmm. So people get off the sideline and realize, as an analyst, Warren Buffett has a quote Bronson likes is, what is the quote, Bronson?
I got a lot of Warren Buffett quotes. I have no idea which
greedy.
When others
be fearful when others are greedy, and be greedy when others are fearful. Yeah.
I personally don't like the quote because I'm an analyst. I don't feel like you should be greedy or fearful. You just go back to work.
Yeah, there's deals in every market, right?
Deals,
yeah.
And the deals right now pencil on the buy, and we get the returns on the buy like we used to have to wait 3 to 5 years from now. Mm-hmm. And as long as we have this buying opportunity, which we didn't have 1 to 3 years ago, which we probably won't in 3 to 5 years from now, structure the recessionary acquisitions fund to be capital heavy, move as swiftly as we can, and keep that velocity of high and compound. Allow 1 to turn into 2, 2 into 4 and 8, and cash flow and appreciate as much as we can, as quickly as we can in this environment.
So how does that look? I love it, by the way. I mean, it's just classic flipping, right? I mean, you're making your money on the spread between the buy and the value, right? So you're just finding those distressed assets and not having to inject capital, as you said, CapEx or anything like that. So it's really a smart play. How do you pitch this to investors? What does this look like for me if were I to invest with you? Like, how much do I need to put in, and how long you're going to hold it? Is it flexible? When do the returns kick in? How does that kind of play out?
Yeah, so I'll just pivot a little bit away from the flipping, because the flipping, which is kind of glamorized on the news, people think you buy it and then you put a bunch of money and you sell it quickly.
Yeah, not a fix and flip, but more of just like a pure...
Almost wholesale, but we're buying and then we're trading forward. So it's a little bit different than the typical flipping model. But to your point, in a sense, it's an open fund. And what's unique about it, and also very cool about it, is instead of investing once, and our minimums are $100,000, and we use accredited investors only, which is why we get to talk about these deals openly right now with you. But yeah, if you invested $100,000 into a normal syndication, they would lock it up in one property for 3 to 5 or 5 to 7 years. You'd miss this entire buying window.
Yeah.
So what's very unique about this, and I just spoke in front of almost 1,000 people in San Francisco, and had a bunch of operators come to me and be like, nobody's doing this like this. Because what we're doing is, when you invest and we refinance, we buy something in cash, we refinance, we don't distribute the refinance proceeds. We use that to quickly buy the next asset. Mm-hmm. When we sell, we don't distribute the sale proceeds. We use that to quickly buy the next asset. And so that means that we keep that stair-stepping of your equity all the way until one day we can't buy the assets anymore. And then we will dissolve the fund. Now, we've given our opportunity, which is the process of selling out everything. Now, in between, we've said, you know what? If you'll commit to 3 years with a 3-year lockup period, right? then we'll let you come in as members and participate and buy units in this fund. But we may dissolve it in 5 or 7 or 8 years. But if you want out before then, we have a 3-year lockup. You could request a redemption of all or part of your initial investment, or your initial investment plus part or all of your profits, right? And so at that point, we allow people for a shorter period of time to invest. But by that point, you got to consider that we put your funds into a dozen different properties that we have stair-stepped up by that point, right? And so the longer you're in, the higher your proceeds aggregate. And our projected returns, which seems high on a typical deal level, right, where we're projecting 30 to 40% annualized returns because it's heavily weighted on the back end. And keep in mind, we are cash flowing like 10% on these properties. We're buying 10 cap properties. So there's cash flow. We do distribute that. But on the back end, the exits are so high. That really is, our target was, well, if they only stay in 3 years, that's what we're looking at, like that 30. But if they stay in 5, we're looking at 40% annualized because it actually exponentially grows the longer you're in there. So, and those returns, people are like, oh, it must be very risky. Well, actually, the risky deals right now are the 14, 18% ones that are hoping for valuation gains and infusing a ton of capital that they may not get a return on. If you look at our case studies, which is how we show this to investors, it's like we have 4 assets that were done out of the fund. We have the first asset in the fund. We're just buying right. There's no magic. We know on the buy what we're making. And each time we know what we're making, and then at one point, if we have a really bad day and we somehow miscalculated, we just sell it for what we paid for it. We don't have to sell it for what we paid for it plus all this CapEx, right? So it's a very low risk play, and we can calculate it each way. And that's really that's what I think resonates. And I think a lot of investors really want to participate. We never even did a webinar. We raised all the capital within that 14-day period for our first acquisition. And we have a ton of commits, and I got over 20 million commits in the portal, just people waiting for our next one. I think they really want to participate in the upside of downturns, and they just don't know how. Mm-hmm. And this is that avenue for how to do it.
Awesome. Yeah. So much good in there that I'd love to pull on. Let's kind of put a pin in it for a moment. And Bronson's been patiently waiting against the ropes there. So why don't you give us some insight into the ATM fund, Bronson?
Yeah. I've just been punching the wall here, waiting to get a chance to go for it. So it's interesting. When I first heard about the ATM fund, I was honestly a little skeptical because I thought, well, do people use ATMs anymore? Mm-hmm. And I just, everybody's going digital. Is that even a thing? And I, through the advice and just the, strong recommendation of a friend, I decided to invest. And I've really, it's become my favorite, if not my favorite investment, it's been my favorite cash flow investment because a lot of things, especially the last, couple of years, that were cash flowing, we've seen expenses rise, we've seen insurance rise, we've seen interest costs rise, stuff rise. And a lot of stuff, has just stopped cash flowing, or it's cash flowing much less if it is cash flowing at all. And the ATM fund, the one that we're in, is with the 4th largest operator of ATM machines in the country. Now we've raised close to $15 million for it the last few years. And it's just been super consistent. It's like, the operator pays monthly. It starts, month 4 after you close. And, just rough figures, 100K invested, returns around $2,100 a month, starting month 4, and it pays every month for 7 years. It's considered a preferred return. It's not a guaranteed payment. But again, if you can predictably have, half your money back in just over a couple of years, there's a lot of reinvestment possibilities. And that's what I think a lot of people also are finding, like, well, what do I do with the cash that I have sitting around? Kind of what Patrick was saying, what do I do with that? Mm-hmm. Well, if you can put it into something that's kind of a little more interim, then it's a 7-year deal. But if you can get a portion of it back and you're getting paid monthly, I've watched investments like this where people have, replaced income, or they've replaced expenses, and be able to have that. So that's one major benefit, is just the consistency of the cash flow. And over 11 years of doing this, the operator has not missed or reduced a single monthly preferred return payment. Could it happen? Of course, it could happen. It is an investment. Every investment does carry risk. But I like that element of the consistent cash flow. And the second thing is it has depreciation. This year it's 80% depreciation. It's 100% total depreciation, but it's 80% this year, and then next year goes to 60, and then you get the remaining amount of depreciation for the years 2 through 5. And the reason why is, and I will say this, it is actually, the depreciation is superior to real estate depreciation. Is actually much, much better. And the reason why is because when you have a multifamily deal, which I know we're all multifamily people, if you carry forward, you accelerate the depreciation to year 1, you're taking a lot of it now. But if you sell in 5 years, you've got to recapture whatever those, you get penalized for the years that you didn't use. So you have kind of this recapture event. With ATM machines, it's equipment that depreciates to 0 over a 5-year period. You bring it forward, and the life of the deal is longer than that time, so you never recapture anything. So it's kind of amazing that we've actually had several investors actually working on another large investor of around $1 million or more from just a single investment coming into the deal, because they're like, I've got all these gains. What do I do that I can actually help have some depreciation that can offset? So again, having cash flow, consistency of cash flow, and also having depreciation are kind of the benefits of how it works. I can get into the ATM business itself, which is very interesting, and just why I think it is growing. It's actually not shrinking. It's actually growing about 4% per year over the last few years, and expectation going forward. So it's interesting. A lot of people, this is kind of one of the biggest things we have to work through with investors, is that an investor will say, I don't use ATMs. And I never pay for ATMs. Like for me, I don't use ATMs unless when I was in Japan a month ago, I used an ATM, but I really don't use ATMs, right? So they think, well, if I'm not using it, nobody else is using it. Yeah. But in reality, 10% of the US population does not have a bank account. It's just absolutely shocking. 1 out of 10. So they're using things like, prepaid debit cards and other things with ATMs, and we're getting paid in cash and different things. But it's just, when you look at the numbers, these aren't like fly-by-night groups saying this. Is the FDIC saying this. There's groups that have done major studies to show there's this huge population of unbanked and underbanked people in the U.S.
That's pretty shocking.
It is, yeah. And I'm glad you went down there a little bit, because I have seen ATM funds coming through my inbox and different things. And that is one of the first things that goes through my mind is, who's using an ATM anymore? I mean, I see them at the banking centers, and I don't know if these are the type that you guys are installing, but they're a little more, right? They have a display. You can connect with an agent live if you need to, you can do your banking with a teller, essentially, in that way. And then I don't know what AI is coming down the road or whatever, but I would imagine some of that's in that way. Yeah, so much for the cashless society that we live in.
Yeah, well, it's a great conversation, because again, this conversation around being cashless and going to a digital everything has been around for 30 plus years, when we started really using more credit cards. But one thing I will say is that, and what is the primary risk? Yeah, that people use less for this investment is that people use less cash. They go to more digital, or the government comes out with a central bank digital currency, and then people start going to that. The challenge, if that were to happen, I think there's major political concerns on the right and left, right? On the left, politically, they would say, well, if we put this forward and people couldn't use cash anymore, who would that hurt? Well, that would hurt this 5 to 10% of the population that's in cash all the time, doesn't have a bank account. So I think they would say, hey, we're not going to, this would really hurt people that have cash businesses. They wouldn't want to do it. Secondly, politically on the right, you have privacy issues. You have major privacy issues. You can say, okay, everything's digital now, but the government can't go in and look at all of your transactions instantly. And then with, if with central bank digital currency and we were all on it, they could literally say, Mike, you've had a problem with alcohol or tobacco. We're gonna cut off the spending for those things. Or if you buy guns, we're not going to allow it with this certain currency. And it's kind of scary. I mean, if you think about like where China's at, where they're an authoritative state and there's a social score and all this stuff, these are real things. This is not like science fiction, but they're not even to a place where they're cashless. But if we want to become an authoritative dystopia, just do away with cash and make everybody use some central bank digital currency, right? So I think until that point comes, and we're seeing a growth in it, I think that the 5,000-year history of currencies, to my knowledge, nobody's been able to completely do away with a physical currency. So I just think that it's going to be here to stay.
Yeah, it's always been a stretch for me to imagine, but I mean, who am I to say yay or nay? But yes, I think it's a big task. Can it be minimized? I would imagine there are ways, but interesting.
What is the minimum investment that you accept?
Right now, we may increase it. It's interesting. It's increments of 52,000. So 52,000 is the minimum. We might increase that to 104, but it's basically, the reason it's 52,000 is when this fund first started. That bought a certain number of ATMs, and so then they just kept it. And it's not like when people own, they like, oh, that's my 3 ATMs over here. It's basically diversified among a pool of like 2 or 3,000. So it's that's the nice part, is you're not like, if you get a terrible location, you're not in trouble, or somebody gets a really great location, they're in good shape. But yeah, so that's the minimum for it.
It's not like a vending machine that you put in the neighborhood restaurant down the street, and that's my vending machine.
Yeah, no, it would be, then you could put your name on it or something.
Yeah.
But these guys are in over 12 states and over 25,000 ATMs, and it's been a great experience working together. And I've done quite a bit of diligence with them too, just to kind of make sure I understand, the walk through the financials, make sure I understand who's doing what, who's involved in which part of the business. But it's been a wonderful experience. And then I have some investors that invest a little bit, and they come back and they're like, there's the money sitting here, kind of like Patrick was saying, there's money sitting here. What do I do? And then they deploy it. Like, man, this is great because of the cash flow. And again, I'd actually kind of ask anyone, is there any investment that that pays consistent monthly cash flow that has been that consistent over the last 11 years? Like, I cannot think of one that's that. Maybe like a CD or something really low, but not at the rates these are paying are very high.
Do you mind elaborating a little bit about the ROI? You mentioned a 7-year hold. Is that for investment?
Yeah.
And then some distributions, but what? Just tell us a little bit about the ROI overall.
Like the average annual return?
Yes.
Average annual, yes. So it's hard to describe this investment because everybody's used to real estate investing and multifamily investing, where you have a common thing we'll see is a 5-year time horizon, and it's like a 1.8 to 2 equity multiple, right? So it's like, okay, well, that's we can understand that. Well, this one is it's a 7-year investment. And it's about a 1.8, 1.85 equity multiple. So it looks like it's a lower total return than a multifamily deal. But I would say, when you get paid in a deal is very important, right? So if I had a 5-year multifamily deal, and like a lot of deals, you get paid a little bit along, maybe you don't get paid anything until the very end, and you double your money. So your 100K becomes 200K, but you don't get anything until the very end. Imagine you had a different deal that you got 90%, including your principal, in addition to your principal, back in year one, and you had 4 more years on the deal. It's very different, right? So that's really the time value of money. That's the IRR. So this one is about a 19% projected IRR, pays consistently. And so if you were to take the total return and divide it up and say, okay, how much are you getting? It's about 11%. But if you look at the actual cash on cash, which is a mix of principal and interest, is just under 25%. So again, the fact that if someone puts 100K in to get around $25,000 on a preferred return back within roughly the first year, that's pretty amazing. So again, but I have calls with people where actually we've had it open. By the time this goes live, it will not be open, but we've had it open. I've just had calls. It's very difficult. Somebody like, well, why didn't you explain it this way? Why don't you do this? Where I was like, I don't know how to explain this because people have this framework they come from that is not very clear on how it works. So I have to explain it that, hey, well, this is the IRR. Because when you're getting money back, if you have half your money back and the deal's still going, you can take that money, you can reinvest that, right? So that's kind of the advantage. It's not just like if you didn't do anything for 7 years and you had this account just kind of build back up, then you'd have not an incredible return. But if you can reinvest, I think that's the big appeal of it.
Oh, for sure. We have a saying that money loves speed. I really think it's so true.
Well, let's I think we have a good understanding of the basics, and we're getting into so let's kind of, for the sake of the show, we'll pivot into round 3. We can dive a little deeper. You guys feel free to ask each other questions and or point out your opponent's weaknesses or things like that. But yeah, those are some of the things that I wanted to explore. Like, I know Bronson, you talked about the depreciation on the ATM side. For the sake of the listeners, Patrick, maybe your fund and its tax advantages.
Yeah. So the way what Bronson's saying is correct, in that there is a bonus depreciation, and the usable life of real estate's a lot longer than ATMs, and that's the difference, right? Because ATMs are basically scrap metal in like 7 years, right, Bronson? Is that the case? Yeah. Yeah. So there really isn't. So it's kind of like I think of the ATM fund as kind of like giving a loan, where you're giving 100,000 or whatever it is, and then you get a principal and interest payment back until 7 years happens, and you've paid off, the principal's been paid off, so you don't get the interest payment anymore, right? And so it's kind of like a throttling. You get a fixed return, but part of that return is the principal payment, and part of it's the interest, and then at the end it's done. So there isn't like an exit on it, but it's really, like as Bronson's saying, it's front loaded. And that's how, when they asked me to describe it, that's how I kind of describe it, because it's a high interest rate loan essentially at the end of the deal, at the end of the day. But Bronson's point is when you take real assets, the IRS will let you depreciate those, and it's kind of like them saying, "Hey, look, over as the years go on, you're going to have some money to keep those assets up, and they don't really have that, so they'll let you write off some of your income." And because the assets are kind of parts, that way the real life of those assets is like 7 years, so there's no what they call recapture at the end if you sell it, right? In real estate, the real life of real assets, right, that people live in, essential needs, right, are 27 and a half years. But we can accelerate some of it to like 5, 7, 11 years. So we will, and in a fund like ours, we'll do what's called a bonus cost segregation, bonus depreciation, to accelerate all of that into the first year. And in a fund like ours, unlike a typical multifamily deal where you get kind of a lump sum of accelerated depreciation, majority of it in the first year, because we keep acquiring, we keep passing out depreciation every year. So it does give you a consistent, the K1 keeps showing new depreciation as long as we're growing that fund, right? Which is kind of cool. And one of the ways that makes it possible is the use of a 1031 exchange, because we can sell a property. And as with Bronson saying, when you sell, you have this big trigger event of depreciation recapture, but not within our fund. Because within our fund, we trade properties within the fund. So the 1031 exchange allows you to trade the basis forward of the asset, so it doesn't trigger. And we do another cost segregation on another asset that we bought at a new valuation, right? And then we keep doing cost segregations, keep doing trades. Now, when we pull out the equity, we buy another asset, that's not a 1031 exchange. But when we sell an asset and trade it into another asset, that's a 1031 exchange. That allows us to continue. And so if you look at our deck, it actually shows, here's the depreciation in year 1, 2, 3, and 4. So it is a little more tax advantaged than your typical real estate depreciations, real estate deals for that reason. Where I look at, I'm very much an essential needs guy, right? So I'm like single, multifamily, the housing, food, and energy is really where the core of the essential needs are. I love alt assets, and I'm an alt assets guy. And if you look at my passive investor guide, it shows an allocation in real estate, and we have other alternative investments. I do worry about the bet that you place on ATMs, because right now there's been talk for 30 years about the Fed coin, but it's now a real reality. So the talk of 30 years has actually happened, right? And the government is rolling out the cashless society now. It has been talk for 30 years, but it's actually happening now. And while the market's been going up steady state 4%, once you buy those assets, you're really hoping on the usability of those over the whole life of those. And I think potentially I think the real estate side's anchored more in that essential need, that there is actually growing population and there is underbuilt. And especially in this recessionary time, you can know the return going in. And at any time in which we see that economics don't make sense, we can exit. And like I said, that could be in 3 years, it could be 4 or 5, right? We're not making a bet on the long-term stability of any particular investment within the fund, any particular market within the fund. We can be dynamic within the fund to choose markets and assets as we see them more favorable and exit those that aren't. And I think that the ability to be able to pivot and see similar returns to the ATM fund, but I believe less downside risk because we're making the return on the buy and not hoping on a particular asset, gives it some advantages.
Yeah, it definitely makes sense. Just to close out on the taxes, are you guys actively within your fund working to offset any, or when you do sell assets, and if you were to pull money out of the fund, there would be some kind of a recapture event, most likely, I would guess, right? And so are you kind of actively trying to offset that with acquisitions, and then also like when the fund dissolves at some point, like you said earlier, whenever you're unable to buy any more assets, I guess would that also be kind of an event that would cause a recapture like that?
Yep. Yeah, there most certainly will be, because the assets we're buying have a longer hold. As long as we hold an asset for more than a year at the end before we exit the fund, it'll be cap gains. Right. Yeah. But we're projecting about 10-20% depreciation a year pass through as we grow the fund. And then as we wind down, that will cap out. And as people do redeem, if they redeem 3 or 4 or 5, you will see a recapture event, depending upon how long you've been in the fund and how much depreciation that you've had. And that's part of it, right? That's part of the value you get of being in real assets. Is I think you're in a bit safer spot because you're an essential need. But if you invest outside of them, the government will look for some or part of that non-captured depreciation back.
Yeah, I definitely like the fact that it's an essential need. It sounds like you guys are doing a really a good job. This is something I did want to explore a bit of. Eliminating as many variables as possible, right? In terms of lending variables, cost of renovations and construction and things like that, right? So it's just down to a core asset and buying right. How are you doing your underwriting on making purchases like that? Is it a fairly? I guess it's a bit simpler in a fact that you're able to evaluate what comps in the market or similar types of cash flowing properties might be bringing, and then you have to make some kind of assumption on the go forward basis. But curious what that looks like at a high level. I mean, I don't want to get into your spreadsheets or anything like that, but just kind of what are the essentials of what you're looking for when you're going in for assets?
Well, you got to be careful talking details with an engineer, because we could go way down the rabbit hole here. I'll geek out with you. But just on the surface, there's really two differences. Essentially, what we're doing is the same stuff as we did before, right? Where we were underwriting based on comparables and cap rates, and doing the same due diligence. But there's kind of two differences. One is we're going direct to owner instead of through brokers, because it's the owners. It's the brokers have been whispering the prices that are no longer realistic into the owners. So we're finding those distressed owners, right? And then we're underwriting without the big capex, right? So we're underwriting for shorter holds. So it's really the same model, except for it's a different outreach engine that produces hundreds of opportunities to reach out to owners directly. And it just simply doesn't plug in the long capex play, and we see if it pencils on a short-term hold. And otherwise, everything else is the same. We're looking for we're doing the taxes, the insurance, we're looking at the rent rolls, the P&L, the T12. We're underwriting everything in the exact same way, right?
Okay, cool.
What do you see as you mentioned that there's really low risk in the type of investments that you're making? What do you see though? What are the risks that you see?
It's lower risk. There's not very low risk in any kind of investment, as Bronson pointed out. You're at risk to lose all or part of your capital, and you need to be able to. If you're going to invest, you need to be ready and prepared for that, because that's part. Unless you're buying an annuity, and you're seeking for greater returns, and you're diversifying. Hopefully, you're diversifying, and not just in real estate. Real estate's one allocation. A great diversification tool is the ATM funds. There's other types of ways to diversify. So as long as you're investing and this is part of an allocated strategy, you're not all in one deal like I was when I lost everything, right? This is a healthy calculated risk. It's a risk-adjusted return. The issue that people run into today relative to multifamily is that they put in maybe $10 million for the property, another $5 million for improvements, hoping that it would appreciate to $20 million. They'd be able to pay back the down payment, the improvements, and then return a profit. And that's not happening. They're maybe breaking even or at a loss right now. And if they can't hold it out past this time, then they're not going to meet their projected returns. Why this is lower risk is because we're not calculating or trying to predict where cap rates or prices are going to be in 2, 3, 4, 5 years from now. We're not trying to predict where inflation will be in 2 or 3 or where the asset. We're not even making a bet on a market or a specific asset class. So we have a much more narrow window, and the shorter you look out, the more confidence you can have, right? And the other side is we're not infusing a ton of capital and then hoping that all the other variables align so that we can return that capital and that investment dollars and then make a profit. And so that's why it makes it lower risk. And on a bad day, to your point, we buy it. Maybe we didn't buy it for the basis we thought. Mm-hmm. We have other offers coming in higher, but maybe as soon as we buy it, those go away. And maybe we got to sell it for what we paid for it.
Sure.
But in that case with us, we're breaking even. Maybe we lost some time. Even maybe we sell it at a little bit less than we bought it for. But still, in a diversified fund, if any particular one asset we mess up on the underwriting, it's not going to collapse the fund, right? And that's potentially the risk that we see.
Yeah, that's good stuff. What about, are you each taking retirement account funds people can invest through SDIRAs or?
I'll jump back in because I've been kind of waiting a bit. I just one thing to respond to Patrick's as well. I think we both agree on this that having some diversity is good. I would say multifamily there is definitely an essential, and I see ATMs are as well. Even during COVID, we saw 90% of total, 90% of regular volumes during COVID. And then they came back within a few weeks to about 100%. So it's, we're seeing, I think the idea of essential is that can change. And, I think there's some different things to look at there too. But yeah, I think, in general, when it comes to, I'm sorry, your specific question, I got distracted.
Just I was responding to retirement account funds and what type of investments can come in.
I got him off his feet there for a second, I think.
Now I got my nose back on. Yeah. Get distracted sometimes. Yeah, we do. We accept different types of accounts. I mean, it's just, again, the biggest thing with retirement accounts, I tell people, just from a perspective, if you have a checkbook control account, it's way easier because you can just say, I want to invest in this, and then you send the funds, versus some of these trust groups that do retirements, they can just take weeks, like 2-3 weeks to set up, or 2 to 3 weeks to have this person sign a paper to go to this department to go. It's just kind of, I don't know if I'm sure you have that experience too, Patrick, where it's like, some people are like, why are you paying money to be a part of this? Because you don't have any control over but we do accept them if they can get in time.
Same here, and I echo Bronson's comments. If you're in retirement accounts, which are traditionally over-allocated into the Wall Street, the stock market, right? And the best way to do that is to carve out a piece of it to allocate. And my passive investor guide shows the allocation of the high income and the ultra wealthy. And in order to do that, you have to diversify out of your employee sponsored accounts and get them into hard assets like the ATM fund or real estate or oil and gas or whatever it is. And most certainly, I got an article in Patrick Grimes' Forbes IRA, and because I'm constantly trying to communicate the value of the self-directed variants of a 401k and an IRA, and there's so little known. And the employers and the employer sponsors are not going to tell you about it because that's like money on their table, like that they feed their family with, and they're not going to trade away. But Bronson's absolutely correct. Checkbook controls are controlled accounts where you can have signing authority and you can sign on our docs, and where you can wire the funds. It's much more agile. It also requires a bit more sophisticated individual. And so I'm kind of split, to be honest. Sometimes I feel like having a custodian account where it's a little more effort for us. We actually call the custodians and we step them through our docs, and so it's like selling to two people.
Yes.
but it does take extra time. But sometimes it rather than not self-direct, right? Do a custodian. If you're sophisticated, go the self-directed route where you have checkbook control. But if you're not that sophisticated and you're nervous about doing it, go to the custodian, maybe upgrade later but just start doing it, right? Because to make it very easy is to just go with one where they sign on the docs and they wire the funds. But long term, if you want to be more agile and you don't want to miss deals that fill up fast, like Bronson and I, then you may want to consider upping your game a little bit.
Yep, definitely a topic for a whole other show. But yeah, we're also big proponents of all that and getting past a lot of fees and different things that come alongside those company sponsored 401k plans. All right, so we are kind of down to the wire here. Did you have any final questions? I think one open point that I had that I either didn't catch or we didn't cover, Patrick, on your fund, is there an advertised average annual return over the life? I mean, it seems like it might be harder to to communicate just because the fund sounds very flexible, but is there some... I mean, it seems like you'd have...
Yeah, so we actually do. So it's a 30 to 40% annualized return. And that was more geared around our projections if you're in for 3 or 5 years. And when you look at our example deals, the case studies, it shows our equity doubling every year. And so people are like, well, why are we only getting 30 to 40%? Well, we're just projecting very, very low returns, right? We want to be, we already get this sense where it's unbelievable. But if the reality is it's not, if you look at the individual deal level acquisitions that we've done. But yeah, it's in that 30 to 40% is what we're projecting on our stats. And since we're a Reg D 506C, just like Bronson's funds, we can share that.
Sweet. Okay. Final questions or thoughts from your side?
No, we didn't touch on Bronson's ATM investment business type. Do you see any risks there?
Of it being an ATM business,
being an investor in this type of investment.
Oh yeah. Well, like Patrick was saying, there's always risks in every deal. I think that there's a few things we look at. One is what is the history of I just came out with a book recently behind me called Fire Yourself, which is over here. How do you vet? And when you vet a deal, you start with the market. I think you start with the market. There's some debate of whether you start with the market and then you go to the person or the operator, then you go to the deal. So I like starting with the market. So when I say if you have a great operator, but they're in a market that's shrinking and not doing well, I don't think you're going to do well. And Buffett has a quote about that too, right? If there's a business or a segment that has a very poor, is very competitive or very poor, I don't know exactly how the quote goes. If it's a very difficult segment and you have great operators, it's the reputation of the business that will stay intact, right? It's like because so if you, it's same with multifamily, if you buy in an area that's growing. So we see with ATMs, we do see a growing market. We do see things growing. There's a chart I have. I think it's 4.3% compound annual growth the last 5 years, and it's expected to go forward for at least the next 5 to 7 years at that rate. I mean, the biggest risk, it's interesting, there is a move to, do we go more digital, or is there some sort of big forced move because of a crisis? It's always a possibility for sure. But again, I think it's not, will that ever happen someday? It's, will that happen within the next 4 years before you have your money back?
Yes.
And then with the taxable benefits, will happen in the next 3 years when you count some of those taxable benefits? I think, in my opinion, I don't think so. But, having some diversity is good. And so, I asked this question actually to Paramount, the guy who runs, his name's Daryl Heller. He runs the ATM company. And I said, what do you think the biggest risk is? And it wasn't what I expected. He said, I'm not concerned at all about that. We're only seeing this grow and grow and grow. But he says his biggest concern is that there would be kind of like a rent control type of thing that comes into ATMs, which New York has presented it a couple times in New York City, where they've said we're going to limit ATM transaction fees to like $1.50, but it is never passed. And even then, the fees in New York, there's so many transactions where the fees are only like $1.95 or $1.75 or $2. So it wouldn't be that big to affect. But I think those are things. You always have operator risk. You've always got an inflation risk. I think the returns are high enough that we kind of get ahead of where inflation really is. But they're different. I think for everybody, I always tell people, just make sure you understand the investment. Make sure you feel like you have similar values to whoever you're working with, whatever the asset is. And that's what we talk about in my book as well. Is just do you really understand your investment? If you don't understand it, if you don't understand what the risks are, you probably haven't looked hard enough, because there's always one or two primary risks. So I gave you kind of what I feel the one or two primary risks for this deal are.
Yep, understood, noted. All right. Well, Lidge and I are going to take a quick minute just to confer. We'll come back, and you guys feel free to keep punching on each other or just take a break there. But we'll be back in just a second with see who the champion is.
Okay, so they came back quick. This is a clear answer, whatever they're going to decide.
It was very close, very, very close.
Yeah, so this one's really good. I love both of these, and actually we'll be writing you both a check after after this is over. But no, we love both of these. I think there's some great advantages, taxes, returns, all that stuff. In this particular instance, it was really close, like Lydia said. We're going to give the nod to Mr. Bronson Hill, who actually brought the glove. And I think really what did it for us was just the time value of money and the fact that you start getting paid day one or month one or whatever, and you can reinvest and things like that. But honestly, both of these are knockout investments, and encourage both anybody to take a peek and see if they're a fit.
I'm personally hooked in both, so I'll talk to my husband.
Good job, Bronson.
Are you going to play the Rocky theme music? So I'm like, dun 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 dun.
I told you, I've been in Bronson's jet stream, right behind him. He thinks I'm past him, but I'm still.
We'll put in an overlay really quickly, Bronson. I know you got a hard stop here, but people want to get in touch with you. What's the best way?
Best way is just my website, bronsonequity.com. You can join our investor club. We've got some free downloads there. I've also got my book called Fire Yourself, which is available everywhere. So check that out and fire yourself and create passive income.
We'll get all that in the show notes as well. Patrick, how about you?
Yeah, so at Patrick at passiveinvestingmastery.com, my email, you can drop me an email, passiveinvestingmastery.com. You can set up I love talking to investors, anything, wherever you're at, if you're accredited or not, I can help get you pointed in the right direction. I also have a book if you want it. We ship out a free signed copy. It was a bestseller. Passiveinvestingmastery.com/book. And that's the secret link. Put the name of this show in the notes so we know who you are, and we'll get a signed hard copy out to you for free. Appreciate your time on the show. It's been a lot of fun.
Yeah, thank you both, gents, for a spirited matchup. Big success wishes to you guys both. I know you're crushing it, so continued success. Hope to bump into you both sometime in the future here at an event or out and about. So wish you both the best and take care.
Thank you.
For those of you tuning in, we thank you so much for investing your time with us on the Cash Flow Fight Club podcast. We certainly had a blast, received some knockout insights, all while learning something new. And we hope you did too.
If you had fun, please subscribe to the podcast wherever you watch or listen.
Lydia and I truly believe the beauty of cash flow is having your money fight for you instead of you having to fight for money. So whether it's one of these methods or something else, we encourage you to dream big and take action. See you next time.